One of my most important and my favorite pieces of investment literature I'm going to share with you here today at the Heritage Wealth Planning YouTube channel, why you need to stay in. If you're going to invest in the market, by market I mean the stock market, the equity market. Stocks and equity are the same thing. If you're going to invest in the equity market, you need to stay in. And I'll explain why here in just a second, because it's critical you understand this most fundamental piece of investment knowledge. So welcome to Heritage Wealth Planning YouTube channel, my friends, the place you come to learn all about your investment strategy and what you need to do when the markets get challenging, because it can get frightening out there. Absolutely, I'm telling you. So you got to be careful to make not the big mistake. So as much as I've been around, you always find a study by an investment group that'll say, time in the market, not market timing, that matters. And man, I tell you, you're thinking that doesn't make sense. I should be able to jump in and out of the market. And the answer is you just can't. I mean, it's just no one can. You can, I can't. Warren Buffett can't. It's just we can't. Because that means you'd be able to predict the future. And if you think the market is based on earnings, any given short term is on earnings, or any given short term is based on unemployment numbers or on Trump or on Obama, it's just silly. There's just no basis for that whatsoever. I mean, go ahead and try it. You're just going to lose your shirt, because many professionals, many algorithms, many AI, all this stuff have tried and they all fail. They just do. I mean, do some make a bet like George Soros? I think what he bet against the pound back in 1992 or something like that. It wasn't the pound. I forgot what the currency was. Greece, something like that. But anyway, yeah, I mean, you can get rich making a big bet, but that's speculation. That's not investing. And we're talking about investing. I'm not talking about speculation, because then I don't know anything about it, but I do know about investing. And so what happens is you always hear these strategies, now's the time to get out, now's the time to get it. And no one can pick it. And if you just ask, do they pick, what is it, 5 days ago or something like that, when the market fell 600 points? Did they? No. And do they pick the next day when the market was up 300 points? No, because no one knows. Now, let me just give you an example. My mom was always a stock picker. She used to read Value Line, even though we didn't have any money, but she always liked it because she's a natural accountant by trade. And she always read this Value Line research. And Value Line used to have this huge publication, like a Encyclopedia Britannica or whatever, of just a stock. So it was always interesting. And I used to learn from her about stock picking. Well, I think it was like in 1994 or something like that. And I think GM just laid off a whole bunch of people. And I'm thinking, ooh, that can't be good for the stock. Maybe it was 1992. I forgot. But anyway, GM just laid off thousands of people. I said, that can't be good. And the stock went through the roof. I said, that doesn't make any sense. Why would the stock go through the roof when they're laying off people? I mean, if you're laying off people, that means something isn't working. And the issue in this case, apparently, was the cost of labor was so expensive. By laying off a lot of people and giving them severance package, they reduce their cost of labor. I said, but they're reducing their cost of labor because the demand is being driven down, and it was crazy. But that's what happened. And that's why I said this will make sense. And then on the other hand, I remember too, when we had huge profit reports on companies, and their stock would go down. And you're like, well, that doesn't make any sense either. It's just the whole thing doesn't make sense. There's no rhyme or reason. That's just all there is to it. So company A issued a $10 earnings per share, and the stock would drop because they were projected to get 11 cents or dollars earnings per share, whatever it is. And you're like, but okay, so they're off by 10%, but they still made a heck of a lot of money, and their EPS, or earnings per share, was still relatively cheap. You're like, wow. Anyway, just there's no rhyme or reason. So the issue here, I'm going to share with you a $10,000 investment in the S&P 500, dividends reinvested, from the end of 2002 on 1/1/2003 to 12/31/2017. That gives us a 15-year time frame. What did that $10,000 do if you just parked $10,000 in the S&P 500 and sat on it from the end of 2002 until the beginning of 2018? Now, remember, that includes from the October 2007 through the March 2009 bear market, and the preceding was the preceding or the superseding, whatever, the huge rally we've had since then as well. So let's take a look, will you? Because this will be fun. All right, so let me get my trusty calculator. So a $10,000 invested in the S&P 500 would have returned 9.92% annually. AROR is just annual rate of return, nothing big there. And your your investment would be worth $41,333. A quadrupling of your money, even though you were around for that huge decline of 2007 to 2009. What if you miss the 10 best days? All right, so if you have 15 trading years, I don't even know what that is. There's 200 trading days in a year, so 200 times 15, whatever that is. All you got to do is miss the 10 best days. You just missed them. What would your return have been? 5.03. And your money would be worth $20,873. So just missing the 10 best days, you halved your return, my friends, and you've halved your account value. Just the 10 best days. What if you missed the 20 best days? 2.09. And this would be worth $13,629. What if you missed the 30 best days? Not good. Minus yikes. 9,374. What if you missed the 40 best days? $6,716. That's straight up ugly. That's straight up ugly. So when I hear all these people saying variable annuities are evil or variable annuities are bad, I'm like, well, variable annuities could at least keep you from missing right here. You would have squeaked out a higher gain, that's for sure. There's no getting around that, even though you're paying a heck of a lot of fees. Now, don't let that fool you into being suckered into buying a variable annuity, because at least you're going to have a assurance that some suggestion that you're not going to lose money. We don't know that for sure, but I get that. I say at the end of the day, if this could be you miss these bottom 30, 40 days, and you actually have a negative return over those 15 years. If I could have put you in a variable annuity to avoid that, that's probably a well worth the trade. However, a good financial planner would say we shouldn't miss anything, because if we stayed in the market during this trials and tribulations of 2003 to 1990 to 2017, we've quadrupled our money. That's just a fact. And what a variable annuity could probably give you right around here, about 5% after fees. And so the difference between a quadrupling of your money and doubling your money is pretty phenomenal, actually. But again, as I hear people say variable annuities are evil, I just chuckle at that, because they do give you a feeling of assurance that you'll get your money back in some regard. Again, every contract's different. But I mean, look at this. If you miss the 10 best days, you've halved your rate of return. If you missed your 20 best days, well, hell, you should have stayed in a government bond. You would have stayed in a government bond, you'd have done a whole lot better than 2.09 with no risk and no ability to lose sleep at night. And that's the issue when it comes to equity investing. You can't do this. Now, I hear all the time, well, what if you missed the 10 worst days? How are you going to do that, man? I just hear that and I just chuckle. Did you? Oh, I did. That's no, how? How did you do that? How did you have from on God's beautiful words to tell you, Mr. Investment Smart Guy, that missed the worst 10 days? How? I just don't believe that. If you miss the 10 worst days, certainly you miss the 10 best days as well. No, because you had to be out of the market. There's just no proof that anyone can do this. None whatsoever. And so I hear this all the time. Well, if you missed the 10 worst days, you would have done great. But no one did that. Not who's invested in the market. Because remember, when you're investing, unlike speculating, you're buying an ownership stake in all the companies. We'll just use the S&P 500, which is America. You are buying an ownership stake in these companies' profits and or losses. Ideally, the companies are going to make more money over the long run than they're going to lose money. And if you have it diversified amongst 500 different companies, some of those companies are going to go by the wayside, as I showed you in the Investment Company of America from American Funds, their chart that they do in a previous video I've done. What I say, if you only had one fund to choose, it'd be that. It does not mean you should buy it, but it just shows you what used to be in the Dow is no longer there, no longer exists. Bethlehem Steel comes to mind. But if you just spread your risk among 500 different firms, you own some part of Home Depot. You own some part of Walmart. You own some part of whatever the companies are that's manufactured. You own a portion of these companies. Some are going to go bust. A lot aren't going to make much money, but some are going to make some money, some pretty good money, to give you 9.92% rate of return over one of the most trying eras we've had since 2000. This is since 2003, but still, over the last 15 years, it's been trying. I mean, we've had a lot going on in the U.S. economy. In fact, the U.S. economy has only averaged less than 3% growth. And yet, look at that. Again, another example that GDP does not reflect in stock market investing, that's for sure. But if you miss those top 10 days, you're only having that. And if you miss the top 20 days, we're talking 20 days. Oh, well, let's just say there's 200 days of trading each and every year. And for 15 years, that's 2,400 trading days. If you miss 20 of those, that's less than 1%. That's 0.0833%. If you only were out of the market 0.0833% of the time, less than 1%, and you miss those top 20 days, you're doomed. You might as well, like I said, you might as well have been in CDs, for heaven's sake. If you're gonna invest, you've got to stay in, which is why I love the two-bucket approach, because it says, for the love of me, I got this money over here in the market. I'm under hell or high water. I'm not touching it. I'm not touching it. When the market declines, I don't care, because I got this cash over here on this side I can tap into. They'll cover me for 3 years or so. Ideally 3 to 4, ideally 2 to 3, whatever you want, but 3 years. I got enough to cover me for 3 years, because historically, if I can survive a decline over 3 years or so, I'm back to where I was. And as long as I can survive that decline and not touch my stock market money, I'll do just fine. So the two-bucket portfolio, you got 3 years of cash sitting here, and you got the rest of the market. And under hell or high water, I'm not touching that market, even when things look dicey. And if you can do that, you'll be a successful investor, as long as the markets work. I mean, just because they've worked in the past, this is my problem with the whole investment analysis that says, oh, I use Monte Carlo. What's Monte Carlo based on? Well, it's based on the historical rates of return of the U.S. stock market. Well, that doesn't mean anything going forward. I mean, it just gives us a number from the history, but it doesn't mean anything in the future, because we have no clue. But if you're going to take the risk that says, I'm going to be in the stock market, well, for heaven's sake, be in the stock market. Stay in the flipping stock market, because if you're going to take the risk, get the reward. And the only way to get the reward, my friends, is to stay in. I hope this helps. Hope this helps. So as always, you like what you see, subscribe down below. Comments, questions, concerns, always welcome. And go to the blog at heritagewealthplanning.com, and we'll see you next time. Thanks now.